We will continue as I indicated with batch 2, and let me also welcome our stakeholders who are still with us up to now, and we will then start under batch 2 with the AECI Modderfontein. It's a private distributor, I believe. Ms. Mkize, over to you.
Thank you, Chairperson. Good afternoon, Chairperson, members of the public, and colleagues. AECI is a licensed electricity distributor located in Modderfontein within the Gauteng province. The company is owned by the African Explosion Limited and receives its electricity supply directly from Eskom. The licensee has a total of 115 customers, with the on-used customer category accounting for 95.2% of total electricity sales, while commercial customers account for the remaining 4.8%. The AECI submitted its tariff application together with its COS study on the 31st of March 2026. The licensee has not yet commenced with the public consultation process related to the proposed tariff application. However, the consultation process is expected to commence during the week of 11th May 2026. NERSA also published the application on its website, social media platforms, and local newspapers, inviting written stakeholder comments by the 21st April 2026. No stakeholder comments were received for this particular licensee. The licensee tariff application is based on the existing cost of supply study, and which supports the tariff recommended for approval. The licensee's COS study compiled with the requirements of NERSA-approved COS framework. The COS study is applicable for a period of 5 years. However, licensee is required to reflect adjustment in key cost drivers for 26-27 financial year. This is in line with Section 18.7 of the October 2023 NERSA approved COS framework, which states that an adjustment index will be issued to licenses to enable the submission of tariff applications. The licensee's revenue requirement, as reflected in Table 4, was determined using the cost-plus approach in line with the NERSA COS framework. The allowable revenue was based on verified bulk electricity purchases and electricity operation costs supported by 24-25 deforms, trial balance audited AFS. Only prudent and efficient costs together with a reasonable surplus are recommended for approval. In recommending a surplus 0.17%, NERSA relied on Section 15(1)(a) of the Electricity Regulation Act, which provides that tariffs must enable an efficient licensee to recover the full cost of its licensed activities, including a reasonable margin on return. In applying this provision together with the COS methodology, Section 4.2 and 4.3 weight states that a profit margin is added to determine a licensee's revenue requirement. All costs have been ascertained, and it's allowed a range of 10 to 20. And NERSA is required to ensure that AECI recovers efficiently and prudently incurred costs, including a reasonable return, while avoiding excessive compensation. In analyzing the application, NERSA considered the actual figures for 24-25 financial year, together with budgeted figures for 25-26 and 26-27 financial year submitted by the licensee. This assessment was done to check that the application is fair and reflects licensee's current operational needs, ensuring that it does not over-recover or under-recover during the financial year 26-27 tariff review process. With regards to the share costs, the costs were verified against the deformed trial balance and audited to ensure that they relates only to electricity functions of the licensee's business. In the absence of the cost subsidy framework, the licensee is applying an increase of 8.76% across the board. The licensee will be advised to develop the cost subsidy framework. In terms of performance indicators, the licensee financial and technical performance is satisfactory. The cost to serve recommends an average tariff increase of 10.99 for the licensees to reach cost reflectivity for 26-27 financial year. However, the licensee is proposing an 8.76 increase to review its tariff for 26-27 financial year. Some of this consideration for this includes the licensee's requirement to maintain a sustainable tariff level to stimulate demand, ability to cover ESCOM bulk electricity costs, ensuring customer affordability. The legal section chairperson will be enhanced as Mr. Matibula alluded at the beginning of this meeting. Recommendations raised as follows. The tariff that are based on the cost drivers are approved as recommended in the tariff analysis session for implementation by the licensee with effect from 1st July 2026. The cost drivers submitted by the licensee be noted. The licensee is required to submit a report accounting for all costs that have been noted to enable the regulator to perform its independent verification or audit process by 30 January 2027. Thank you, Chairperson.
Thank you, Ms. Mkize. Members, questions, issues of clarity or points of enhancements on this particular application? If you have any, please do raise your hand. I don't see any hand, Ms. Mkize, on your submission. I think it was quite clear and straight to the point, covered all the issues that the members have raised in previous applications. On that note, members, may I take you to the recommendations? They are on page 2 to 3 of the second batch of attachment under the documents on convene. And the recommendations have been read into the record. May I, by show of hand, get an indication that you support them, members?
Chairperson, you're on mute.
Thank you, members. Oh yes, I've read the name of the members supporting the first one. AECI Moderfontein. I noted Mr. Mkize, Ms. Maseti, Ms. Magjola, and I do support. We move on to the second application. Bito Municipality, Ms. Matumbu, over to you, ma'am.
Thank you, Chair. Good afternoon, members, colleagues, and the public at large. Bito Municipality is situated in the Western Cape and has applied for an average tariff increase of 12.12. It is supported by an existing cost of supply study which used the cost plus methodology. Chairperson, the municipality submitted its council resolution and proof of having conducted customer consultation together with its tariff application on 31 March, and no correspondence regarding objections received was submitted to NERSA. The application was published on the NERSA website in accordance with the prescribed processes, and NERSA received one objection from the Civic Accountability Advocacy and one from a private individual. Both stakeholders highlighted the worsening affordability pressures on low-income households due to rising electricity tariffs, fuel costs, and transport fares, and emphasized that these cumulative impacts informed a submission they tabled at a council meeting. We responded to both the comments by stating that the responsibility of receiving, recording, and tabling public submissions, as well as ensuring that due process is followed within council or mayoral committee structure set with the municipality and not the regulators, and that the regulators' role is to assess the tariff application submitted, including the extent to which it demonstrates compliance with public participation requirements, and that in evaluating this application, the energy regulator applied the principles of cost reflectivity, financial sustainability, customer affordability, and while the tariff adjustments are necessary to support the recovery and of efficient and prudent costs, as well as the continued sustainability of the electricity service delivery. Due consideration is also given to minimize undue tariff shock on the customers. Chairperson, from a financial and technical perspective, the municipality is performing very well. It recorded a surplus of 9.46 and energy losses of 6.99 as per the audited financials of 2024-2025. The cost of supply study reflected an average tariff increase of 43% for the municipality to reach cost reflectivity, and the municipality adopted a 3-year phasing approach to gradually align its tariff to the COS outcomes. The tariff structure reflected cross-subsidization, and the municipality is encouraged to develop a cross-subsidization framework to objectively address cross-subsidization in a fair, transparent, and cost-reflective manner. The application used a cost adjustment tool, and the underlying costs considered OPEX and CAPEX related in terms of depreciation. The municipality reported an asset value of 261 million and depreciation of 5.6 million, which were extracted from the deforms and verified against the audited financial statements of 24-25. Chairperson, the depreciation was verified against the asset register, and it was found that the asset types make up the total depreciation. The assets, Chairperson, included transport assets, machinery and equipment, pump station, low voltage networks, medium voltage substation, medium voltage networks, municipal offices, furniture and office equipment, and computer equipment pertaining to the electricity department, and all the costs amounted to the 5.6 million of the depreciation. The allowable revenue for 26-27, Chairperson, is 340, and it has a depreciation of 7 million and a surplus of 17 million, which is 5%. To ensure that the surplus is reasonable and not overstated, the margin was tested against the NERSA cost of supply tolerable range of 10 to 20, and it was found to also be in line with the EPP policy 1. The surplus was also assessed against key risk factors, which include revenue collection risks such as non-payment, bad debts, operational risks, which include energy losses and aging infrastructure, and the need to remain financially sustainable for the electricity function. Chairperson, the municipality is up to date with its ESCOM account, and it does not have any areas or ESCOM interest. No NMD penalties were found, thus ensuring that customers are not burdened with avoidable costs. Chairperson, the adjustment tool indicated that the municipality should increase its tariff by 15%. However, the municipality opted to increase its tariffs by an average of 12%. This increase will ensure that the municipality meets its ESCOM bulk increases while mitigating tariff shock and protecting customers. All members' comments from the previous presentation are noted and will be incorporated to enhance the RFD. Accordingly, the REC is recommended to approve the tariffs that are based on the COS report for the implementation of by the municipality from 1 July 2026. The cost of supply report submitted by the municipality be noted. The municipality is required to submit a report accounting to all the costs, that have been noted in its cost of supply to enable the energy regulator to perform its independent and verification audit processes. Thank you, Chair.
Thank you, Ms. Matumbu. Members, any input from your side? If you have any, please do raise your hand. I'll let you come in. Ms. Masetti?
Thank you, Chairperson. I'll be quick. Chair, I just want to get clarity on the issue of the asset value. and depreciation. Because it is obviously not provided here in detail, like as a table of its own, and talk to the asset value that we found, and depreciation, because the depreciation amount that is in the financial statement, as we repeatedly indicated here, that it is an aggregated one, and so how do we then do the verification of that depreciation amount to make sure that this indeed relates to the electricity assets, electricity distribution assets? So that is the first thing, so that we can make sure there is no over compensation in that regard. That's the first thing. Still on the depreciation, now taking you to table 4, you will see there on table 4, which is something that we've been dealing with on the revenue. There is an line item that we've been, talking about: operational expenditure, inclusive of depreciation. You will see the figure there for 2024 as an audited one. And then you see the 2025 that has been put in there. And then there is a 2026 amount that is there. Now, there is I just want to understand that figure compared to what is being claimed, where it says current year depreciation. And then for each of the years, it is stated there for this year is 7.2 million asked for depreciation. Can I just get an indication here whether there is no duplication in the calculation of depreciation, or is just the breakdown coming from that entire figure of 52 million? What exactly is happening? If I can just get clarity there, if that is the case, the way that I am reading it. And then, Chairperson, the other thing that that I would like to get clarity on, I don't know whether I'm seeing fines, penalties, and so forth. Are we now allowing fines and penalties and all of that as an amount that must be added on the revenue? Because that line item there, it shows those amounts that are added in the revenue requirement. So if that can also be clarified, because they fall under general and other. So if I can be assisted on that. Then with regards to the shared OPEX cost, so on the shared OPEX cost, I think it's important, just so that we understand the typical shared costs that are assigned to the municipality. I see the amount, but I'm just not sure what the percentage of this amount that is here, how much it represents when one looks at the entire business of the municipality, so that the other cost that relate to other divisions, or where they should have been, say, maybe we should have just transferred or accepted 15% or 10% or whatever the case may be. We don't end up allowing 20 or 30% of the total shared cost within the municipality. As we know, the municipality provides other services. So now this figure of the shared cost, what does it entail in terms of the breakdown? I would like to leave it at that, Chairperson. Thank you very much.
Thank you, Ms. Maseti. I think from my side, it's on the comments that we have received on page 38, and I do note the fact that we have responded to the individual that commented, but our response is merely giving clarity on our role in that of the Munich, but I did not get an indication from the presenter as to whether have they received any confirmation from the municipality that they've undertaken their public participation process. And apologies if I missed that, if it was mentioned. And the second thing on the table 4 as well from my side on page 34, I think maybe you may need to really as well enhance the cost items that relates to salaries and allowance under OPEX, the first line, and also again salaries, wages, and allowances in the fourth line. So I think we have raised this in previous applications, but when you read this, sometimes it makes you think that there is a double counting on those two points. I think the other one was on contracted services. At least on this one, I don't see it. But if you can just enhance, maybe by indicating in brackets as to what the salary is, how do they differ, that will really help. Mr. Mkiza?
Chairperson, thanks. I just got a challenge with my convene, but on page 22.226, I see these very huge increases of 24%, 24.42, 22.51 for the commercial one. I think it's important to kind of go to some lengths to explain such, because when you look at the figures, it's it's almost a quarter of the existing amount, and it's a concern just on how high these are. Like the one is double what the increase is in the others. We need to balance the interest of the consumer and the sustainability of the municipalities. Hence, us really going to town to explain such. Thank you.
Thank you, Mr. Mkiza. I don't see any other hand. You may come in, Ms. Matumbu.
Thank you, Chair. To start with your comments, I did indicate that the municipality conducted a consultation process, and that they didn't send us any objections on their side. I did mention that. And in terms of the enhancements you indicated that I should add, I will definitely do that in the final RFD. To answer Mr. Mkiza's question, the municipality applied applied differentiated increases. However, when we take in all the tariff components for a specific tariff, the average increase goes to the 12.12. I can enhance those tariff categories to show the average increases, so that it shows that the overall increase of what the customers will be experiencing is actually the 12%. To answer Ms. Maseti, the depreciation breakdown, Ms. Maseti, I can provide it on the enhanced RFD, and that figure, ma'am, was verified against the electricity trial balance and deforms, and which used the audited financials, and the breakdown of those assets can be included. We can provide to enhance the RFD. In terms of the penalties that you mentioned on the table, you are correct, ma'am. That line item actually shouldn't be under a general and other, it should actually be under under other revenues, because it is the fine and penalties that the municipality imposes on people who they find have illegally connected to the networks, and maybe missed their payments. I will correct this table, ma'am. And in the other question that you asked in terms of the I think it was the 52 million. It is inclusive of the depreciation, ma'am. So there's no double counting in terms of the depreciation. The 52 million is inclusive of the depreciation. Thank you. I hope I've answered all questions. Thank you.
Thank you. Members, are you covered? On my side, I'm covered. Any?
Chairperson, yes, Chair, I'm not covered. I think maybe she needs to be she needs to be assisted there on even on the last point that she mentioned. There's a standalone line item that we've been talking about. She confirms that it includes operational expenditure as well as depreciation, and that amount is 52 million. So depreciation is already there in that amount, and it's in bold. Now, why do we have a separate line item on a depreciation for current year depreciation? You will get that under general and other. Just look at that one and then look at the items below that. You will see that there's a line item that says current year depreciation. Then it talks about the 5 million, 2024, and so forth. But for this year, they're asking for 7.2 million. So I'm asking, why is that figure when we already have depreciation on the 52 million that is a standalone there, and there's confirmation that it is already there? Why are we still recovering depreciation of that amount? It is wrong. That is a very serious one that we need to take care of. And even this issue, I don't know, maybe she verified the issue of the fines, the penalties, and so forth, because we don't know whether these are penalties for NMDs or whatever it is, but she says that it is other income. So if it is other income, why is it not covered under the line item below? Just look at the line item below. You will see that we've got in bold, after total expenditure, including surplus, you will see that line item immediately after that. That line item talks about other revenues. So if these fines and penalties are what the municipality is recovering, so it means then that item is already included there. It should be included there. And so that it is not added there as a cost that the municipality must recover from the tariff. It is wrong. It must be removed. So I can count a number of those, but just on these two, you can actually see that there's problematic line items that are included here. And then even the shared OPEX is not clarified here properly on the shared OPEX, as I indicated, to say, how did we verify that all of the cost that we are now required, about 19.9 million, that this 19.9 million is the cost that must be recovered from the electricity tariff? How do we know that amount is not insignificant at all? So there are those specific things that we really have to, we must get answers on those, because they're part of the revenue and they translate to the tariff required. And then there's a rest there, Chairperson. I'm not going to deal with all of them, but the table is just problematic and adds cost, and those costs are not justified. Thank you, Chair.
Thank you. Ms. Matumbu, do you want to come in?
Yes, thank you,
Or
Chair.
maybe any of your team members or so, Ms. Mabinya, whoever wants to assist you, they can come in. But you may start, ma'am.
Okay. The 52 million, Ms. Maseti, it is the total amount of the operating expenditure, which includes depreciation, which is the 32 million you see on the general and other, and the shared OPEX. Those numbers add up to the 52 million. It is not that the listed items are then added again on the depreciate on the 52 millions. Hence, I'm saying that the 52 million is inclusive of that depreciation. And I did mention that fines and penalties are mistakenly put in the wrong line or cost section. They should be under the other revenues. They are not there currently under other revenues. Hence, I indicated that I will amend this table and enhance and make sure that it is corrected in the RFD. Thank you.
But on that last point, Ms. Matumbu, if I heard Ms. Maseti, she is saying the fines and penalties, right? I think it's that point on reconnection fees or something. I'm just assuming that. She is saying the fact that the municipality has imposed it on its customers, it's sort of, they've received that money, but why are we then adding it up again onto the revenue requirements calculation? If I heard her correctly, and that's my just simplified explanation of what I heard from her, she can come in and address that, but I don't think you have clarified that particular part, particularly for me, in terms of what I heard her asking you. And then I will go on to Mr. Mkiza so that you can come back. But just think of that clarity that Ms. Maseti is seeking on that fines and penalties. I don't think you answered it. Mr. Mkiza, over to you, sir.
Thank you. My only question related to the issue is, if that is the case, are we saying that if looking at fines, penalties, and forfeitures or something, it should then be treated the same like reconnection fees, because it is the other revenues, but then gets subtracted instead of being added. So now, it being there, does it have a material impact in terms of the change in the increase required? I just want to check that, you know. But if you're saying that it's mistakenly there, I'm fine with it, and I think that's where actually it belongs.
Okay, last round. Let me take Ms. Maseti, but last round of response from you. If the answers are not satisfactory, we may have to postpone this matter. Ms. Maseti?
Thank you, Chairperson. Chairperson, that's what I was going to suggest, if the members agree, because there is a challenge there in the way that this is done. Apart from the above, operational expenditure that inclusive of depreciation, and then you also have a total expenditure. So some of these things, there are line items that are added there. I'm not very comfortable. I mentioned all of the ones that I've picked up. So they are problematic. It clearly says that at the end there must be those deductions, and then given those deductions, there must then be an adjustment, so that when we take the decision, at least we know that they're mentioned, and when you make an adjustment, the adjustment gives or yields X amount, and then at least we are comfortable that we did what we're supposed to do. So from my side, I will leave it at that, Chairperson. Otherwise, for me, it's problematic. Thanks.
Thank you. Ms. Matumbu, are you okay? I think the members are proposing that maybe take it back, clarify these important issues, and when you come back and present, just focus on them in terms of providing us with the clarity, because we have read, we have gone through the submission, we have commented in all other areas, but on these ones, because they relate to the revenue requirements, they may have a material impact on the outcome that we are supposed to make as a committee. Are you okay with that? Or maybe your team member last round, Ms. Mabinya? I don't see any other hand. Okay, we'll resolve on that. Members, are you, by show of hand, agreeable that we take this back so that they enhance those issues that need to be clarified? Thank you, Ms. Masetti. I support. Thank you, Mr. Majola. Mr. Mkize. I think, members, it is important that when we consider the matters, we just try and indicate our reasons as to why we're not voting. That's what I wanted to highlight to Mr. Mkize. I think he has been kicked out or he's got a challenge with the connection. We will move on to the next one, which is Ndumeni Municipality, Ntate.
Good afternoon, Chair. Thank you. This application of Ndumeni, it has been consulted by both the municipality and NERSA. There hasn't been any comment from both parties. The municipality on this application, they are proposing 10%. The cost plus methodology was used on the cost of supply. The shared costs were verified on the audited AFS, and there is no cross subsidy. Also, the OPEX and the CAPEX were verified on the audited AFS. The COS was revised by the municipality as a result of changes in ESCOM tariff. The cost table, Chairperson, will be expanded to include the cost individually on the table, costs such as the bulk purchase, material and suppliers, salaries and allowance, contracted services, the depreciation, and bad debts and other general expenditures, so that they can be reflected in the orderly manner that the members have advised us to do so. Chairperson, the risk associated with the surplus of Ndumeni is high losses. This municipality is operating at a very high percentage of electricity losses, 45% to be specific, and also the interest, NMD, and low collection rate. So the municipality indicated that the reason for high losses is mainly because of theft of electricity within their area of supply. The table 4 in our analysis indicated that the revenue analysis that we performed, that if the municipality can put more attention and pressure on energy losses and reduce it to a single digit of acceptable 9%, they can perform at a better financial performance, is indicating a percentage surplus. The municipality is also proposing 10%, and we are recommending it as proposed. Another thing, Chairperson, the municipality is encouraged to recover the lot of revenue that has been lost as a result of high electricity losses. Chair, if I may read the recommendation, they read as follows. We kindly request the REC members to approve this application of Ndumeni to be implemented from the 1st of July, and also note the cost of supply that has been submitted together with the application. And also the municipality need to quarterly submit a report to NERSA indicating a plan and what they are doing to reduce and monitor the performance of their energy losses. I thank you, Chair.
Thank you, Ntate. Members, any comments, issues of clarity, points of enhancements that you may have on this application? If you have any, please do come in. I do not see any hands and don't have any inputs from my side. I don't know, we seem to have lost Mr. Mkize. Ms. Janssen from Firen, please do check on him.
I had that trip, I'm back. Thank you.
Oh, okay. All right. Thank you. Do not see any hand. Members, the recommendations have been read into the record. They are on page 87 to 88. And by show of hand, can I get an indication that you support them? taking into account all the enhancements that have been raised in previous applications. Thank you, Mr. Mkize, Mr. Majola, Ms. Maseti. I do support. We move on to the next one, which is in Kandla Municipality. Mtate Ramuhulu, over to you.
Good afternoon, Chair and REC members, and also NESA staff and member of public. Nkanja municipality is one of the municipality situated in KZN province, and in terms of this application, NESA, the municipality NESA consulted on this application, and we from NESA we didn't receive comment from this application, and in terms of this application, the municipality is seeking for 12.9% based on the CO study, which has been revised, and then the total cost reflectivity is 38.2%, and we have noticed that the financial performance is not satisfactory, and then we also tried to do the energy revenue loss analysis to say if these guys they can go to a single digit energy losses, then the surplus will be, they were gonna have a surplus, and which means this municipality needs to be encouraged to improve their technical efficiency. And in terms of this application, we we look at the the new COS, where we have to look for efficiency, so that the municipalities can be allowed efficient expenditure. And in terms of this application, they apply for the revenue requirement of 15.334 million, and then the revenue requirement include energy purchase, which is around 7.34 when include from also plus the energy losses, which amount to 3.34, which constitute 22% of the revenue requirement. And we also in the revenue requirement 2.23, it's for operational expenditure, and also the surplus is around 1.39, and also these municipalities is also using the cost plus methodology. And then what we did, we verified the efficiency. The energy losses were disallowed from the revenue requirement, and also the other inefficiencies were also disallowed. We had efficiencies such as NMD, which was disallowed, and also payment to ESCOM debt, so that customers need not to be. And also the other issue that we realized that based on the performance, we realized that if the municipality has to improve on the on the energy losses, then the municipality can be easily earn additional income, which means this municipality need to be encouraged so that they can be able to improve on the performance. And I mean, the depreciation which was verified on the DIF form and also AFS, we found it to be correct, and the depreciation amounted for 805,983,000, which we were certified, and also we were also happy in terms of in terms of cost allocation. What I can also indicate is that this municipality is mainly I mean, the costs are beared by domestic and also commercial customers, and that's what we found out. And when we, after checking the COS, we the in terms of the rate, or also the cost of activity was 38.2, which the municipalities at least they chose to face in the increase. And other thing that I can say, yeah, I think those in a nutshell is that's how the municipalities is doing, to say we need to encourage them to be more efficient so that they should be able to recover the costs of doing the business also. And then I think this is the picture that we found out from the municipality, and then we also like the REC to approve. I mean, to also to know that the tariffs are based on the COS revised COS report and be recommended as per the tariff analysis section for implementation by the 1st of July 2026. And also the REC, or the energy regulator, to note the COS submitted by the municipality, and also will request the municipality to submit all the costs so that the energy regulator can be able to perform its independent verification or audit by next year. And I think this is a municipality that we need to monitor its performance. And also, lastly, Madam Chair, is that we also require that the municipality needs to provide a quarterly energy losses plan or and project report, which we need to monitor commencing from the 30th of September. I submit, Madam Chair. Thank you very much.
Thank you, Ntate Ramohulu. Members, any inputs from your side on this particular application from Kandla? Any comments, points of enhancements? Yes, Ms. Maseti, you may come in, ma'am.
Thank you, Chairperson. There was a lot of confusion here as I was trying to listen to try and make sense of what is in the document. Things like, in the revenue, we included energy losses, and then later on we say the energy loss. I don't know what exactly is the issue. And then we also talk about the cost of supply study. A new cost of the supply study must be submitted. There's just a lot of things that I could not follow. But anyway, Chair, just to I'll just rely on my own engagement of the document itself. First of all, on paragraph 3.2, which is on page 122, I mean, you can see there that the performance of the municipality has deteriorated dismally from the losses that were from the what you call from the surplus. I don't know why it's from the deficit of 19. Now it is sitting at 51.5. Just there again, if we say it's deficit, I don't think that we need to show it by negative, because we've already said that deficit percentage is X amount instead of saying minus, because it's a deficit anyway. And that obviously is what affected the revenue of this municipality. So clearly, if we were to even look at that table, the way that it was put by Mr. Ralupe, we could have seen a lot of these inefficiencies, including the fact that the ability to collect revenue, the NMD accidents penalties. So there's just a lot, and the ESCOM and stuff like that. What is it? The interest and the debt and all of those. So I don't know how we are showing an adjustment here, an adjustment in terms of the revenue that is required given the high energy losses, that just like what we have done, which we need to do anyway, because already we have highlighted the what you call the inefficiencies. So we cannot lump the revenue with so much inefficiencies. We need to make an adjustment. We've got inefficiencies that are sitting, that is not also doesn't allow that doesn't relate with the, okay, let me just put it straight. The inefficiencies of 72.4% energy losses. That's quite significant. It's substantial, actually. And it's also is coming from 64.3. We can't not adjust for this. Now, table 4, it does not show that adjustment, where we actually show that the expenses, the income is far less than the expenses, 23.7 million compared to an expense of 36 million. That's a lot. So even if we take them to at least 12%, then we can start seeing the difference. We need from that to include an adjustment, a reasonable adjustment, instead of jumping to that 29.6% surplus. That adjustment is, we've got to do it, Chairperson, because we have done it with the other municipalities that were even far better than this one. And I am not seeing it under the revenue that this municipality requires. And the other thing that we need to consider to now demonstrate this inefficiency is by at least assisting members to say this inability or failure of this municipality to collect the revenue. It is showing from the fact that the sales are X amount from the bulk purchases of ESCOM, so that we can be able to then show that net loss, to say, well, they're only recovering from 50% or 55% of what they are buying from ESCOM, so that we can actually see that aspect. And we guided on that 3 days ago. So the table 5, it's really not it's really not helpful in my view, and it does not even show the what you call the adjustment that we need to make, irrespective of such significant inefficiencies. So we will be taking a decision that contains those significant inefficiencies without adjustment, yet we have done the adjustment in other matters. Secondly, the surplus of 9%, it is just too much coming from this other, I mean, one is from for the wires and then the retail business. Why are we giving them so much when they are unable to recover? Why are we giving them so much of surplus? So I will say that surplus will also need to be adjusted. Those are the two critical things for me, Chairperson, that affect the decision that is required. Thank you, Chair.
Thank you, Ms. Maseti. Mr. Mkhize.
Thanks, Chairperson. Firstly, I note that on table 2, there are no, there isn't free basic electricity being afforded to the indigents. And it can't be that in this municipality you don't have some. That is a concern. And then on the very high energy losses in any entity, if you ring-fence just the electricity, this is not a going concern. If you look at it, and I'm not against this benchmarking and going to energy loss of 12 then 6. It's easy to write it on paper, but in actual fact, to address it is not that straightforward. Because you are also saying under 3.3, the high energy losses were primarily driven by unmetered and illegal connections. But the measures to deal with that, you highlight them as strategic. For me, these are just basic operational measures that are important that need to be done here. You want to talk of meter audits when there are no meters to audit. Let the intervention talk to the problem in real terms and raw. I don't want to delve into what has already been said, even though one could be coming from a different angle. Let me leave it at that. Thanks, Chairperson.
Thank you, Mr. Mkhize. Mr. Majola.
Thank you, Chair. From my side, I would zoom in onto Table 5, revenue requirements components. Because at the end of the day, we need to come up with a number for the revenue requirements, and we need to make sure whatever we do is in line with that NESA framework that we've been talking about. So I see 2 items there that I want to focus on the table, which is the energy purchases from Eskom, net cost of losses, which I think comes to a total of 7.3 million and some change. And also we've got energy purchases from Eskom, cost of losses. Then there you can, I can see you've got 3.3 million. So if you can just explain where you got those numbers, the 7.3 and the 3.3. Where did you get those numbers? Thank you.
Thank you, Mr. Majolo. And I think we all are concerned with this particular municipality, and I've also as well noted the high energy losses of 72.42. And there's no plan really to say how the municipality is intending to address this. And the inefficiencies that Ms. Maseti highlighted, and if you look at what is said in paragraph 4.4.16, we are saying the cost of supply is giving us 9.01%, and we are recommending 12%, 12.9. If I'm correct in terms of the numbers, I'm just trying to find out as to how did we move from 9 to 12%. And also, my other point is covered by Mr. Mkhize on the FPE. 900 customers, none of them are getting the FPE. And I wanted to check because with other applications, We have seen a standardized item on the amount that they get from National Treasury. The term is just missing. It's just it's disappearing in my mind. There's a term for that. They get money allocated for them to provide the FPE. It's not even indicated on this. Are they getting that money? If they are getting it equitable, something, where are they? How are they using it? It's just not
Equitable
clear.
share.
Equitable, yes, thank you, Ms. Maseti. And I think maybe this is one of those application, Mr. Ramohulu, that I think we need to take it back, and for you really to try and re-look at these figures. For me, I think based on the input from the members, they are not really happy with this. Can we take it back for you to just go and look at these and numbers and double check the information that you got from the municipalities? There are huge amounts that doesn't warrant that 12.9 that is recommended. Members, that is my suggestion, so that we do not really get into detail on this one. There's a lot that needs to be clarified and in the submission. Thank you, Ms. Maseti. Thank you, Mr. Majola. Thank you, Mr. Mkhize. Ndate Ramhul, I just hope we have given you proper matching orders in terms of what you need to do on this application from Gandla. Can we then, I've seen members, they've supported that we take it back, and can I then request that we proceed on the next one, which is Nkomazi Municipality. Ms. Kekana, over to you.
Good evening, Chairperson and board members. I would like to bring to the attention of the members there's an error on paragraph 4.4.1.15 where the energy losses were incorrectly stated as 33.52%, and the correct energy losses percentage is 5.5%. And also there is an omission. I made an omission of the asset values and depreciation statement, which I will read into as I go on with my presentation. Now, the Nkomazi municipality is a municipality situated in Mpumalanga province. In the previous year, the municipality have revised their cost of supply study. In the previous year, they applied for 15.2%. In the current year, they're applying for 15.1%. The actual performance of the municipality, they had a deficit of, in the previous year, a deficit of 24.96, and in the current year, it's 9.10. Apologies. A deficit of 10% and energy losses of 5.3% in the previous year, and energy losses of 7.1% in the current year. So Nkomazi utilized the revised cost of supply study developed by SIA to determine its revenue requirement. The revenue requirement of 311 million, which is 66. It accounts for for the financial year 26-27, the municipality is applying for a 2% surplus on the cost of supply, and the municipality opted to use the cost plus methodology aligned to the NERSA COS framework. When verifying the cost drivers, the inefficiencies such as bad debts were removed. There was no interest in NMD. The shared costs were ring-fenced and allocated strictly to the electricity business and verified against the deform, verified with the deform. The deform verified against the audited AFS trial balance and in line with the COS framework. The risks identified were the revenue collection risk. And on the COS, there's an allowed surplus of 2%, ensuring that the surplus is not overstated by aligning to the policy position 1 of the EPP and COS framework. There were no cross-subsidization, and the Munich, the NERSA complied. Oh no, pardon. The assets, pardon, excuse me, Chairperson. The asset values in the of the municipality was 151 million, that was from the AFS, and the depreciation was it was a 43 million from the trial balance. 43 million from the trial balance. The method used was a straight line method, and the NERSA followed the project consultation processes and undertook its own processes. No correspondence received from the municipality of the comments received from customers. And regarding the OPEX, the OPEX before including the OPEX was 86 million, and the OPEX excluding the depreciation was 49 million. It consisted of the materials and supplies of 7.3 million, contracted services of 3.9 million, salaries, wages, and allowances of 38 million. The recommendations are read as follows. The energy regulator notes that are read as follows. We recommend that the tariffs based or included in the COS be approved. That the members note the COS applied for, and the COS applied for, and the municipality to submit a report accounting for all the costs that have been noted. That is the trial balance, that have been noted from the trial balance and AFS to enable the regulator to perform its independent and verification and audits. And the municipality and NERSA have complied with the statutory requirements on public consultation processes, and there were no comments received. I thank you, Chairperson.
Thank you, Ms. Ketana. Members, any questions and issues of clarity that you may have? Yes, Ms. Masetti.
Thank you, Chairperson. Chairperson, I would like to start off with the fact that if you look at Table 2, Table 2 does not show that this municipality is utilizing the cost and the revenue from the electricity sales appropriately. If you look at that alone, you will see that even on street lighting, I mean, it takes about 2% of the share there. On the, if you look at the sort of, I would say the market share, if I were to put it like that, but it is split on the consumption itself of electricity. So for street lighting, there's a lot that is being consumed, which now is above 2%. And if you go further, you look at this municipality in terms of the electricity to other to other departments is quite a lot in terms of the municipality, in terms of the how much is consumed by other departments within the municipality. How do we account for that? That the fact that some of the electricity that is purchased, a lot of it is consumed, I think is plus minus 10% consumed by other departments within the municipality, and making sure that we recover from this municipality that is sitting on a deficit of 10%. So for me, that is an issue that just needs to be addressed. Then moving on to trying to look at these can I just understand here, why is it that a percentage here on Table 4 on revenue requirement, we've got 13 million of coming from 2.4, and then it went to 10, now is sitting at 13 million of other revenue. And then we say this represents about 4% of the total that is required. And then why is it that it is a minus there on the percentage? I just want to understand, why is it a minus on the percentage? The percentage that must arrive at 100. Can I just understand why that percentage of 4% is a minus there? Then again, I get confused. You will bear with me, Chairperson, because I just want to be certain here. Because in the body of the document, we are supposed, what is being asked, and now this is exactly what we talked about earlier. You will see that the allowable cost that are required or revenue is 311 million on top, and also at the bottom. You will see that there is the same figure here. Now, why the same figure if we remove, or we are supposed to disallow 13.1 million of other revenue? Why do we still remain with the same? So for me, that is something that needs to be clarified, and that is the major one, Chairperson. If I were to just deal with the specifics in this municipality, I'll leave other issues of corrections and all of that. But that, for me, just for the decision itself, is important for the adjustment in the decision required. Thank you, Chair.
Thank you, Ms. Masuti. Mr. Mkhize.
Thank you, Chairperson. I think I must say this. Whilst I appreciate the scrutiny that we are exercising as this committee, but remain of the view that let's get this happening within the division itself, such that we don't have to find ourselves having to go through this. And I hope that this is the last time. Yes, there will be those odd moments where we pick up numbers not corresponding or incorrect in one way or another. But really, if we are working well and want to work efficiently, this should not be the case. So I hope in next year's application, these will be very rare find in between when it comes to this kind of applications. Please, it's good to scrutinize, but at the same time, we must take note of being efficient. I know we're working under time pressure, and I'm very empathetic to that. I would like to then go to the issue of what is in the submission. I won't repeat what has been said, but when I look at page 146, you've got the energy losses being very high. You've got the surplus on the negative. That is page 146. It despite the energy losses being single digits. You've got 2024-5 being 7.17, but still the surplus is sitting at -10, having moved from 25% almost, and they are moving in the opposite direction, so to say, when we expect it to be the other way around. And I'm asking myself also to say to the team needs also need to consider the issue of this street lighting and the amounts that are sold to municipalities. You never know, and do the comparison among also the municipalities themselves, so we can see if there's some wastage there, because even the figures as they are here, they show that there are other factors at play that are affecting the surplus position of the municipality. Then when you go to table 5, yeah, I could be understanding it wrong, but I take it that if you've got the average increase in rates being here, you've got 15.1%, and then you've got the increase in rates to reach overall cost reflectivity, it being 16.2%. It means that you've just allowed that difference of 1.1%. And if that differential in other municipalities is bigger, to take into cognizance the affordability of municipalities, there is also one factor where we need to zoom in to see if this can be lowered a bit. So there's a balance, and we do take care of the affordability issues for the residents in a municipality. Please look at that. In other words, just for and the analysis to take all these other things into consideration. May not be for now as such, but I'm saying going forward, let's make sure that we kind of enrich our analysis. Thank you.
Thank you, Mr. Mkhize. I think for me, my issues are on table 4 or on page 148. If you look at it at the bottom there, it says that costs of losses disallowed. There are dashes there. I interpret that to mean there is nothing. However, I think Mr. Mkhize has also touched on the indication of, as an example, as one of the losses that should have been disallowed in my view. It's the 7.17 energy losses. There may be others, but they are not reflected. I just want confirmation as to whether I'm reading this correctly or not. And the second thing, I think that the Rolof explained something to Ms. Masset in one of the application. I think it was on one presented by Ms. Tanda, to say that when you look at this table, you look at the total costs, and that amount right at the bottom, that total cost, you deduct it from the allowable cost at the top. But when I look at those numbers, 311 million, they seem to be the same. Am I missing something, or I'm just interpreting this table wrong? So I would like to be clarified on those two issues in relation to that table 4. Thank you. Over to you, Ms. Kekan.
Okay, thank you, Chairperson. I would like to respond to Ms. Masetti's questions first. With regards to the street lighting, Ms. Masetti, how it works at the municipalities is for sold and energy sold to other departments. It's the departments within the property of the municipality. For instance, it would be the municipality selling to the tourism department, or it would be the municipality selling to the water department, but within the municipality. On the second question, on the second question, with regards to, pardon? With regards to the second, can I be reminded of the second question of Ms. Maset? I had it. Chairperson?
Yes, Ms. Kekana.
May I be reminded of the second question of Ms. Masetti? I had it in mind, it just went out.
Okay, I didn't note it down. Let me allow her to come in and ask you other. Ms. Masetti, do you want to come in?
Thank you, Chairperson. Chairperson, remember that we have a team here. We've got an HOD and so forth. So the team must assist each other, because we really spend time on this. We are really trying. First of all, she did not even answer the question that I've asked. I know what I've mentioned already, that there's 2% of the sales of the municipality that go to street lighting. I'm quite aware of that. And then there's an amount of 10% that goes to other departments. Then the question is asked, how do we verify that these other departments actually do pay for the municipality? Because there's no high energy losses, but it may well be that the municipality is not recovering the income that it should be recovering from those other departments that is selling to. I already know those other departments, water and other services of the municipality, that I know. But the question is that the percentage of sales in terms of consumption by the other department is quite high. And also the street lighting, consumption for street lighting, there is something that is inefficient. So it's also more than 2%. Now that takes you to over 12%. And is that maybe not something that is causing this this deficit, because it's not energy that is lost, is stolen or whatever, but it is probably given to these other departments and they're not paying for it. Maybe that's why we're seeing this. That's what I wanted to clarify. And then the other question that I asked the chair, which is the critical one for the decision again, and is in terms of the adjustment that needs to be made. It is that amount of 13.1 million, right? If you go to other revenues on table 4, right? So if you look at that, you need to deduct it. You have also shown it there that you need to disallow it. Then you are not then showing the outcome of the fact that you disallowed or the disallowance from the amount requested by the municipality, which is 311 million. So when you disallow, how much then? And I'm saying that figure is the same as the one at the bottom. So it shows that there is no adjustment, downward adjustment that has been made. Thank you.
Thank you, Ms. Musetti. Wait, take note of the questions that are asked, Ms. Kekana. I just want to allow members and also your team members to assist to respond, but I will give you an opportunity to do so. Mr. Majola, you may come in.
Thank you, Chair. My suggestion, Chair, is that this one, we do not continue with it. We go and review it. And I'm going to tell you why. You know, again, as I'm talking to you, I'm actually looking at that NESA framework, table 1, which actually tells you how you calculate the required purchases in megawatt hours. It tells you that sales forecast A, expected sales to customers; B, electricity purchase for own use; C, street lighting. Then it gives you a total. Then it says it allows you what is called an allowable loss factor, which is 10% of what you've already calculated before. So in other words, you're supposed to take the sales from Eskom, the electricity that you're going to use for your own use, the street lighting, you get a total of that, and you multiply it by 1.1%. And that should actually give you what your purchases in megawatt hours should be. So, and then of course, because they're saying to you it's 1.1%, it should be. So if you now end up with a loss factor more than 1.1%, I mean, if the actuals are more than that, it means that we probably have to do some adjustment. So all I'm really saying is maybe let's take this submission back and just let's, so that we can just make sure that when we talk about the purchases, it's in line with this NESA framework for doing this work of calculating the purchases that are required. So I would really suggest we do that, because I looked at the table that was supplied. I think it had two numbers there, and it's a little bit confusing. Probably, if we just take a step back outside of the meeting, we might actually find that maybe we're just talking past each other. But when I'm just looking straight at the formula, when it says sales forecast, it says electricity purchase for own use, it says street lighting, then it says an allowable loss factor of 1.1. I'm not seeing that in the table that was presented in the submission. And as I say, you might find out that maybe we're just talking past each other, but let's take a step back and just within the team review this whole thing based on the actual methodology. Thank you, Chair.
Thank you for the guidance, Mr. Majola. So Ms. Maseti is showing thumbs up, but let me take Mr. Mkize. Mr. Mkize.
Thank you, Chairperson. I'm also looking from a point of view of being effective and efficient, and would really implore the presenters to say, if you see that maybe something needs to be patched up, corrected, just gracefully withdraw the submission, and then we proceed, because we've got other submission to do, and you just do the work and put the submission at the end of the queue so that you can be able to move with speed and really dispense of those that are ready to be taken care of. And I'm starting to get a feel maybe that we pass this one and continue with the others and come back to it when some of the things have been patched up. Thank you.
Thank you for that guidance. I think all the members have seen your indication that you support that we take this back so that it can be enhanced. Ms. Kekana, please do take note of the points that members have made so that you can be able to correct what needs to be corrected. And colleagues can... Okay, thank you. May I emphasize that please do as much as you can to take notes. I'm also trying so that we don't get to a request to repeat, but if there's a need to do so, you can ask. We move on to the next one, which is Sundays River Municipality. Ms. Matlo, over to you, ma'am.
Good afternoon, members, colleagues, and members of the public. Sundays River Municipality is situated in Eastern Cape. The tariff application is based on the existing COS that is valid for 5 years and was used to determine the cost driver for 26-27 financial year in line with Section 18.7 of the COS approved framework. The application was advertised on the NEPSA website, the social media, and there were no comments after the deadline from the stakeholders. And the municipality is still consulting with the customers, and they will submit the proof of consultation by the end of May. Costs that were built up to allowable revenue were verified from bulk purchases, ESCOM invoices, and were tested against deform, trial balance, and an audited financial statement. And then the cost drivers that were used in determining the allowable revenue are on table 5 of page 176, and the depreciation amount is 2.7 million, and the total assets value amounts to 145 million. With regards to the depreciation, what we did, we verified the asset register to make sure that the assets that are on the assets register align with the depreciation amount, and the assets that we found on the asset register is HV substation, and those amount they tally with the depreciation amount. And the municipality recorded a surplus of 2.18, and the energy losses are standing at 20.60. And the municipality has measures in place to reduce energy losses, and those measures, they will be enforced. And if the municipality reduce the energy losses to 12%, they will have a surplus of 2.2 and a revenue of 18 million. And the municipality has applied for a surplus of 12 million, which a return of 2% on OPEX, including bulk purchases. To ensure that the profit margin is commensurate with the risk, the following risk factors were considered, taking into account the financial performance of the municipality. There are revenue collection risk, operational risk, financial and stability requirements, and the municipality did not exceed its NMD. And with regards to the COS results, the COS reflect an average increase of 44.1%. However, the municipality opted for an increase of 10.30% for customer affordability and sustainability. With regards to cross-subsidization, domestic customers are being subsidized by commercial and industrial customers, and future COS updates will refine tariff structures and reduce distortion between customer categories. And the municipality has implemented uniform approach in all their tariffs, and the recommendations are as follows. Tariffs that are based on the cost drivers are approved as recommended in tariff analysis for implementation 1 July 2026. The cost drivers submitted by the municipality being noted. The municipality is required to submit a report accounting for all the costs that have been noted in the study to enable the energy regulator to perform independent verification by 31 January 2027. The municipality to submit energy losses reduction progress report by 30 September 2026 for the energy regulator to monitor the implementation thereof. All the other comments and enhancements raised by the members will be considered before the RFD is published. I thank you, Chair.
Thank you, Ms. Maklo. Members, any input from your side on this particular application? Members, I don't see any hand. I do recall Ms. Massetti in one of the application on table 5, she did ask about the current year depreciation in the manner that is stated here and even in the other one. And Ms. Massetti, if you can repeat that question, I don't recall it being answered at that time when we were dealing with it. So I see it here as well under current year depreciation. Can you see that amount?
Yes, Chairperson, I think she must just clarify it from the perspective of double dipping, first of all, and then also just the verification from the given the fact that there will be that aggregated depreciation in the audited financials, and it has already been accounted for on the top. Thank you, Chair.
Okay, thank you for that assistance. And I've noted as well, this is the first one that I see without double cost item on salaries and wages. Ms. Maklo, do you want to just provide that clarity on the current year depreciation?
Okay, with regards to the current year depreciation, this I think I'll also need an assistance from my colleagues with regards this on this operational expenditure, including depreciation, is not a double dipping because it's not. I will need assistance from my colleagues, Chair.
Okay, Mr. Ramohulu or Ralufe, please come and assist.
Chair, I request Maria to assist, or Lauren.
Okay. Maria? Colleagues, can you come quickly? It's almost getting late and we still have other applications. Please, can you assist?
Okay, Chair, let me try to, okay. The operational expenditure here under the depreciation is considered as an expense item, whereas, it is considered as an expense item compared to the one that was used on the allowable revenue. Thank you.
Mr. Majola?
Thank you, Chair. Just a question from my side. Maybe it will help the other presenters as well. I'm looking at your table 5, municipality revenue requirements. And I can see you've got a line there called total energy purchases, 481833. And then you also got a cost of technical losses as well. So I take it that that number, that 2565, you've actually taken it to be 10% of the total energy purchases from Eskom. In other words, 10% of that 48218. Am I correct? Or
yes, Chair,
maybe,
but I am.
So when you answer it, I mean, you can answer it at that time. Because, and why I'm answering, so that I want to link it back to the previous presentation where we said let us actually package, because it was confusing as to how they arrived at the losses compared to the purchases from Eskom. So all I'm really just trying to check from you is whether your cost of technical losses, which is 2,565, is 10% of your energy purchases from Eskom, that 4,818. So you can answer it when you answered every other questions from other members. Thank you.
Thank you, Mr. Majola. Ms. Musetti?
Thank you, Chairperson. Chairperson, you are quite correct, because these things we're going to have a problem with them. We can't have. She's coming up with something else now, and it is the second time that we today we're getting these kind of things, because we have not come across this kind of a calculation. We already have a figure there of 33.7 million for 2026. And that figure already entails the depreciation. Kandi, how is depreciation calculated now if you can't calculate depreciation from the asset value? And that's what people have been saying all along. How can it now change? The only way that the people have done today was simply to take those asset values that are in the audited financials. Where they are not there, they're aggregated. They were able to take the assets or the asset register, add up the values, and then come to a value that they will utilize, which they are going to also verify again. That's what they were doing, and that's okay. And then from there, what they did, they then calculated depreciation. There is no other way of calculating depreciation without taking that into consideration. Any accountant in the room must please come in and clarify that aspect. There is no other way. So this thing of coming up with another figure here, we add it here, it's double counting unless you prove otherwise and clarify that figure of depreciation, which is already included in that 33.7. How much is that figure? And how you have now ensured you did not duplicate it by adding that other line item. I think that is important, Chair. Thank you.
Thank you. Ms. McLeod, please do come in.
Chair, can I kindly request to withdraw the submission so that I can go and double check? Thank you.
Okay, thank you. Members, are you supporting that withdrawal?
Before we withdraw, can I just Madam Maseri, just again to repeat the double counting on depreciation? Because I can see the line item that says operational expenditure, including depreciation, it's 33, then 797. So, and then I can see that that number, that 33797, is now broken down into general and others, which is 1467, and then it's also got shared OPEX as well, and then which is 19126. So I thought that it actually is that now when you take when you take that general and other, which is the 14670, I thought then that the depreciation is part of that, and that 14760. So that 1467 is actually part then of the operational expenditure. So I just wanted to understand that part of the double dipping.
Chairperson, through you, if I may.
Yes, please.
Thank you, Chair. Chairperson, you will see under total, because I don't know how they've arranged this. You will see, for instance, just as a simple answer to the clarity, you will see that there is total expenditure. So if the way that there's an attempt to interpret this differently, and the one is bolded there, the one that includes depreciation, and the one at the bottom for total expenditure, right? So you will see that if we say all of the other elements under operational expenditure items on their own that are making up this, then you're not gonna get the same figure there, because you need to split that amount. You can't have that amount there, and then you then get to this. There's a figure of 84.5 or something like that, if I'm correct there, Chairperson. So if we're now talking about expenses, operational expenses, so what do we mean there? Do we now say that we're talking about charges from other municipalities, the bad debts, and then shared cost? I don't know. The shared costs are probably made up of those two items. I don't know if that is the case. Then you've got general expenses, where you include these commission expenses and whatnot. Is that what we're talking about? And then the general, which says other expenses, which are not even explained what are those other expenses are. So all of those things, are they now forming part of that operational expenses, and then it gives us the total expenditure? So for me, that is the part that I am not comfortable with, which is not justified. Whether we're now saying that from the amount of 48, amount of 33 for the, what is the, I'm struggling simply because of the number. Only 3 million of that 33.7 million is depreciation, of which depreciation is taken from the audited financials, and that depreciation has been verified, that it is depreciation that has to do with the asset values for electricity. That information is not before us. I don't know it. And I would not then be comfortable without this and try to make sense of this without clarification that is very clear. And all of these other expenses that we're adding here, that we have never added, all of these expenses, commission expenditure, other expenses that are not explained, and all of that. So I don't think that it will assist from my viewpoint. Thank you.
Thank you. I think the author has requested that we withdraw the submission, but let me take the member's input so that when she withdraws the application, she covers all the points that the members are going to make. Mr. Mkhize, you may come in.
Thanks, Chairperson. I'm a bit confused on the side. I want to get clarity, because if you look at general and other, as well as shared OPEX, all of that should amount to the operational expenditure, including depreciation, which is the 33,797,102. Which then, if you look at the current, I think it will help also to number these lines so that it becomes easy. Well, if you look at the current year depreciation, it then pulls depreciation out of that amount, therefore delineating what is in there. So as long as that is not repeated elsewhere, right? Because if you look at the shared OPEX, it then talks of the bad debts, and with the understanding that based on the allowance for impairment, that is limited to not above 5%. And then there are contracted services, then salaries and wages. That I understand to be part of that. Maybe if she can just give, in terms of the write-up, talk to this depreciation being on the assets that are solely for the generation, for the supply of electricity. And then with regard to the general expenses, maybe she can just talk to these other expenses in terms of just giving assurance or some comfort that those expenses are actually prudently and efficiently incurred. I think that would then be able to take care of these matters in terms of us approving. And then, as we said, that there is further interrogation and improvement on what we are going to be approving this day, going to the next phase of application. There's a lot of work that must be in the intervening period. That is my understanding. And as I said, I do have anyway some discomfort in terms of the granular manner in which we were dealing with this, but we have been put to this by circumstances which I don't think that is necessarily optimal. Thank you.
Thank you, Mr. Mkhize. Mr. Majola.
Yeah, thank you, Chair. Firstly, thanks to Madam Maseti, for explaining, where she was coming from, because I needed to understand where she was coming from and why I needed to understand, so that, as the President has requested, that the item will be withdrawn. So I'm also in support that we withdraw. And then outside of this meeting, we'll sit together with the team and address these issues and then bring back the submission. Thank you, Chair.
Thank you. Ms. Matumbu, do you want to come in or should we?
Thank you. Thank you, Chair. I wanted to assist Kwena in terms of the calculation. The line item which says operating expenditure including depreciation, it's a sum of other general and other costs and the shared OPEX. The line item which says total expenditure before surplus is different from that operating expenditure including depreciation, because it includes the total energy purchases and the cost of technical losses which are on top or on that table. I hope that maybe it clears the questions around the numbers for Ms. Maseti. Thank you.
I think that is noted. Kwena has asked that we withdraw the submission. Let her include the explanation that you have assisted her with in terms of enhancing the document. Members, I think all of us have indicated that this be returned and it will come with those particular enhancements. Kwena, thank you. We then move on to the next one. It is yours, Umsobomvu Municipality. Over to you.
Through you, Chair, based on the enhancements that were requested, I kindly request to withdraw Umsobomvu. Thank you.
Are you saying that it is the same reasons as what has been raised in Sunday's River application?
Yes, and also I also need to enhance the comments raised by the members, as some other questions that were raised might come for this submission.
Okay. Members, on this one, do you have any other input that you would like her to take into account? That because I'm assuming you have read this document and there may have been comments or questions that you would have wanted to be addressed. Do you have any, so that when Ms. Matlow takes the submission back, she can include them?
Very quickly from my side, it must be those issues that we spoke about regarding because even on the previous one, they have a tendency of putting 1 million to 1 billion. So they must check those things, because they are then wrong and they really cause some confusion when you need to see whether these things add up on the table that deals with the major part of the decision. So we can't put figures in billions when even the revenue required is in millions. Thank you, Chairperson. There's a lot of that. And even on depreciation that they have extracted, it shows in billions, which then makes one worry, because it might be in billions in the audited financial, and it is an aggregated number. So please, if that can be looked at. Thank you, Chair.
And thank you very much, Ms. Maseti. And Ms. Matlow, thank you for agreeing to withdraw and enhance the submission. May I request that those that we are withdrawing, can they come back tomorrow, because we still have a biggish number to finish in terms of the applications. Members, we're now going to move on to batch 3. Thereafter, we'll go to those that we have stood down earlier on in the morning. And we'll go to Enoch Mkhize Municipality, Ms. Liburu, and I trust that we have been noting the comments that members are making on the other applications. Over to you. Ms. Liburu, Enoch
Chair.
Mkijima Municipality, maybe she's not here. Yes, that the material.
Yeah, Chair. Ms. Liburu sent me a note here that she's not feeling well. So she requested that she present Enoch Mgijima tomorrow, Chair. Thanks.
Okay, does that mean there's no one who can assist her in the presentation? If not, okay, we'll move on to Swartland Municipality. Over to you, Ms. Matumbu. I think this was one of those returned applications. You may come in, ma'am.
Thank you, Chair. And you are correct. This is one of those applications that were returned, and the reason for it being returned was the members requested that I engaged legal in terms of the approach that I used in this with regards to the application, because Swartland has an ongoing case with NERSA, where they requested that the NERSA decision for 23-25 be set aside, and the matter was argued in court and judgment was reserved. So for the purpose of this application, ma'am, we used NERSA 25-26 approved rates as a base. The municipalities proposed an average tariff increase of 11.44, which is council based, which they are currently implementing. And when we although those implemented tariffs were not approved by NERSA, the resulting effect of the increase is 14.72 when we compare the proposed tariffs to the NERSA approved tariffs. And the regulatory assessment which we took, as I've mentioned, is based on the approved 2025-2026 tariffs, and the proposed tariffs for 26-27 were therefore assessed and derived from the NERSA approved rates, reflecting that increase of 11.44. And this approach, Chairperson, as per legal, is found to be guided by the principle that the energy regulator is entitled to rely solely on the most recent approved tariff determination that remain lawful and operative for regulatory purposes. And consequently, the 25-26 municipal tariff determination constitute as the applicable base, which the 26-27 tariff application is assessed on. Therefore, the utilization of the approved 25-26 tariff rates used as a base is consistent with the established regulatory practice and does not amount to a reconsideration or pronouncement or on the validity of any decision currently subject to judicial law. Thank you, Chair. I'm not sure if I should touch on the, since it's a submission, should I touch on the surpluses again, or I just focused mainly on what was the reason of why the submission was returned. I remain guided, ma'am. Thanks.
I think that is fine. Let's rather take questions from the members. I would not limit them on any part of the application. They can ask them as well, and you'll have to respond to them. Members, here is this submission that has been returned, and I don't know if I should just bring in Mr. Murati just to confirm the legal part, but let me take Ms. Maseti first. Ma'am, you may come in.
Chairperson, it might be prudent if you can bring in Mr. Murati, but I do have specific economic and technical issues on the analysis. Thank you, Chair. If you want Mr. Murati just to touch on things that are relevant just for today. Thank you, Chair.
Thank you. That will assist so that if you have any question on his part as well, you can edit. Mr. Murati, please do come in.
Thanks, Chair. may we allow Ms. Mkhize to assist. She dealt with this matter.
Okay. Miss Mkhize, please
Good
do come in.
evening. Good evening to you, Chairperson, and the members. Chair, I just want to confirm what Madam Matumbo has put before you. We have enhanced the legal section. We have reflected on the position that the 2023 judicial review, which is pending before the courts, does not prohibit the regulator from determining the tariff. You'll recall, Chairperson, that in the previous year as well, this was the position because judgment is reserved. And the colleagues have just indicated to you, Chair, that they have looked back at the base being what was determined in 25-26. And yes, Mr. Murati has also had a look at the enhanced legal section. So, Chair, if there are questions, we'll take them. Thank you.
Thank you. Members, Ms. Masati, you were the first. Please do come in, ma'am.
Thank you, Chairperson, for the opportunity. Chairperson, then I think for completeness of what we have taken into consideration, and also the important issue of harmonization, reading all the legal requirements in harmony, I am requesting again as an emphasis that we add the Municipal Service Act, in particular, Section 74, Sub 2, Sub D and E of that Act. So that is the first thing that is important to justify and to also read it with our COS framework. Then, Chairperson, I would like also for enhancement that we add the on the requested tariff of 11.4, so that we do that pie chart that I have requested yesterday that we include here, which is the tariff and versus the revenue impact analysis based on customer categories. Where are the customer categories? Are on table 2 on page 33. That will take care of and I think it was done on the NISNA one in detail, and that will take care of two things. One is to take care of the average tariff, which is an issue of the cross subsidization across customers. That is a fundamental issue that we've been faced with by these municipalities. And secondly, it will also show what the impact is in terms of these customer categories in line with step 4 of the COS. So I'm just making that again as an emphasis for purposes of the legal requirements that we need to fulfill on this. And then, Chairperson, I would like to zoom straight into the what you call to the table that deals with the revenue requirement. Just bear with me, Chair. Then on this, Chairperson, the key issue that we need to get right here, and this issue is part of step 1 for the underlying cost. The subsequent steps on the COS, one just deals with your issues of energy charge and the others, then the cost allocation and so forth. But the underlying costs are on step 1. So that's where then on that step 1, you read it with section 18.7 of the framework, of which section requires that we consider the OPEX and consider the CAPEX plans, which we must assess and approve. And then it also talks about the increase that must be linked to the CPI on the OPEX. That's what is stated under section 18.7 of the framework. So that is going to then assist us in relation to the fact that only on the tariff and revenue of 2024, we can't really use that as the base year. However, what we can then use is the audited financial statements insofar as the asset values are concerned. So we need the person that presented to talk to that aspect in particular is quite key on all of these matters that were before the court. So if they just for verification to talk to that aspect and the calculation of the depreciation and then the reasonableness of the margin linked then to the surplus. That in that order, and this is for enhancement and the approach in which the person must just assist us on that aspect. And then I move on then, Chairperson, to then deal with, I just want to check, you can see the cost drivers. So we've got quite a substantial number under the CAPEX. And I hope that having guided you on the basis of section 18.7, you will then explain that big number on the CAPEX, taking into account the fact that there is that what you call the equitable share from the government, and we also just need to understand what are the capital projects that the municipality is projecting here, which are taking us from 33.9 million to 55.6 million. So you need to speak to that amount before we allow it. And you will do so on the basis of section 18.7. So that if then, as a forecast, if then you are not, you need to verify first, but also then we will do or subject it to the audit for further verification, since it must align to the plans on the infrastructure plans of the municipality to justify that CAPEX, and then we audit it. I hope that I've guided you properly so that when you come back, you talk to that aspect properly, because it is a big item there and we need to check it and justify for appropriately for that item. The other thing that you then need to do here, there is going to be a challenge, at least from our side, for the decision. If you don't provide that table when you go to the line item operational expenditure, including depreciation, please do that table that was done by others today. For this meeting, tell us the depreciation that you have seen in the audited financials of 2024. There's nothing wrong with that. You deal with the audited financials and take out the figure from the balance sheet on the asset values, but verify if those are the assets that must be for electricity, like others did for the verification, as well as so that you can be able to extract the correct and calculate and adjust the correct depreciation amount after you have taken into account the appropriate asset value from the audited financials. And then you can be able to justify that part that has not been splitted, that you did not split in the calculations. Then, Chairperson, I just want on the last item on this table is on the I just want, I'm looking at the amount that is required as the revenue for the municipality, having removed and disallowed 28.3 million. I am unable to see that in the calculation on this table when you disallow that amount. I would like to stop there, and I believe, Chairperson, if the person who's dealing with this matter, if that person can provide proper clarity on these things. And if she does not have the figures at hand, she can just indicate so that we can then maybe take it back and it can be done. Those figures be extracted and reasons be enhanced. Thank you, Chairperson.
Thank you, Ms. Maseti. Mr. Mkhize.
Broadly covered, just one question that I wanted to understand. Did this Munich refuse for purposes of application, at least, to use the NERSA approved tariffs as a base? Explicitly so. Thank you.
Thank you, Mr. Mkhize. I think just to guide the presentation on the legal input that Ms. Mkhize has given, it's noted by the members, and I think Ms. Maseti requested the addition of the provision in the MFA just to beef up the legal section. So, Ms. Matumbu, just start on the requested percentage, which is I think 12%. Ms. Maseti said you needed to demonstrate with a pie chart the impact in relation to the cost that needs to be stated in that pie chart. So start there and then follow with the other questions. You may proceed over to.
Thank you, Chair. Which 12% is the chairperson referring to? The municipality requested 11.44.
Oh, yes, I meant that. Sorry.
I might have missed Ms. Maseti's question in terms of a 12%.
No, it's me. I thought it was 12. It is 11.44. Apologies for that. May proceed.
Oh, okay. No, thank you. Chairperson, the municipality's underlying cost considered OPEX and CAPEX related in terms of depreciation, and the asset value is 806 million. With depreciation of 15 million as extracted from the audited financials, and the assets, Chairperson, were verified to ensure that they only relate to the electricity department because they are electricity infrastructure, the furniture and office equipment, machinery and equipment, the operational building, and the use of computer equipment. So these were verified against the audited financials and the trial balance. And with Ms. Maseti's guidance, the breakdown will also be enhanced in the RFD. The question in terms of CAPEX, which Ms. Maseti asked, it is the municipality implemented a critical, indicated that they implemented a critical network infrastructure which was required to support their service delivery, and the project include them applying to Eskom for a new 132 kV in-feed point to one of their supply points, which is Malmesbury, south of Malmesbury. I apologize for the mispronunciation of the name. This was to accommodate the low-cost housing developments and to enable the anticipated expansion in their industrial area through their De Hoop substation. That is why that CAPEX amount is that big. That is the project that the municipality indicated that they have undertaken, and hence the figure for CAPEX is like that. And with Ms. Maseti's guidance to expand more on the table and show all the cost drivers, that will be done, ma'am. Thank you. I hope I covered all of Ms. Maseti's comments. and questions. Thanks.
Thank you. Members, are you covered on all of your questions? Questions starting with you, Ms. Masiti.
Chairperson, no, the table will have to be revised. We're not going to be in a position to take a decision. I've already indicated, Chair, that there is a substantial figure that we are disallowing there. And that figure is the figure that deals with the other income. And it doesn't show then, after we have taken care of that figure, removing it and disallowing it, how much are we left with as the revenue for this municipality? So that on its own has not been dealt with. It's not there. We need it, Chair. And so that the adjustment is proper and it will show us. So otherwise we can't take a decision from my perspective. And the other critical thing, Chair, is also on the issue of the cross-subsidization. We know that this is a contentious issue, also from our side and also customers that are impacted. Hence, my request, and which we have already indicated a day or so ago, that a critical analysis on the customer category, it is proper to be done. And there is I can remember that we had it on NISNA, for instance, NISNA municipality. We had that assessment. It shows properly everything that we need to look at so that we can justify and see how the different customer categories are impacted when you compare tariff and revenue. If we do it like that from the NISNA, tariff application, you will actually for yourself see that there are critical elements that are there. So it addresses the contentious issue on cross-subsidization and the affordability that has been raised, which is a contentious issue. And secondly, it is in line with step 4 of our own cost of supply framework. So those things are not here, Chair, and I'm a bit worried about what we have and the fact that these things, despite this guidance that I've outlined it nicely, it's not responded to in that manner. Thank you, Chair.
Thank you, Ms. Masiti. Mr. Mkize, I believe you are covered. Ms. Matumbu, can we request that you do what is requested in terms of going to address those two substantive issues raised by Ms. Masiti? I think I managed to write the one on the cross-subsidy, which requires the categorization of the customers so that we can just have some transparency and understanding of how the municipality is doing. And the other one, Ms. Masiti, was on the disallowed revenue. Just assist me with
yes,
that.
Chair. It is on the disallowed 28, I think it's 28 point something million of other revenue. So that we do the adjustment there to say then if we disallow this, then how much is remaining and those kind of things. They are not there. Thanks, Chair.
Okay, thank you. Members, any objections to that? Tomorrow when this submission comes, we just address those two critical issues because other points have already been covered in the discussion that we've just had now. Any objection to that? Members, show your hand that you support that those two critical points be addressed by and be brought back tomorrow. And that will be the focus of the submission, noting that other areas have been covered. Thank you, Mr. Majola, Ms. Masiti, Mr. Mkize, and I do agree. Ms. Matumbu, I think that is clear what exactly you need to bring tomorrow in terms of this particular application. Members, we have come to, that was the last one that was set for today, but we need to go back to those that we had requested that they be stood down. There are 3 of them, and the others will be coming tomorrow. Maybe let me just take a roll call on what is going to be considered now. It is Emma Langeni Munich, it's George Municipality, and it's Inkosi Langalibalele. And I'm hoping that the presenters are ready with those 3. And those that are going to be brought back tomorrow is the Rendwa City Municipality, Bato Municipality, Nkomazi Municipality, Sunday's River Municipality, Umsobomvu, and there was one, Enoch Godongwane that the presenter is
Hi,
said not to
Chairperson.
be.
Enoch Mkijima, please, not
No,
Godongwane.
not the Minister of Finance.
Okay.
Enoch Mkijima.
Apologies. Oh, apologies. I think I'm drained. Mr. Mkiza requested that we take a brief break. Can we do that? 10 minutes. Apologies. Enoch Mgijima Municipality, that was to be presented by Miss Liburu. Hey, apologies. I'll be sued. Thank you. Can we take members 5 minutes or 10 minutes break? Mr. Mkiza, you have requested a lengthy one, and I don't know if we can manage that. We just want to finish these three and then wrap up for the day. Your hand is up.
I will join maybe slightly later because it's something personal I need to attend to during that period.
Okay. Just a comfort break, members, then we will be back at 1900. IT, if you can assist us to stop the streaming. To the members of the public that have joined us, we are just requesting 10 minutes comfort break. We'll come back at 1900 and deal with the other applications that we have stood down earlier in the morning. Thank you, members. And IT, please do assist with the streaming.
Chairperson, should I stop it or just leave it until the 10 minutes? Because for me to stop it and then to do it again, then I'll need around 5 minutes to do it. So I think it's just wrap up.
Okay, not stop, maybe pause. I don't know how you guys do it, but that's what I was saying. Thank you.
All right, thank you.
But it is safe to pause because people might actually come in and start talking. So usually these things are, if people are able to pause the live streaming, we can't leave it on from our side. It's not
Yes,
safe.
that's what I'm saying. Can she please pause it then to switch it off? I think initially said switch off. So she was explaining that she will need 5 minutes if she was to switch off. Just pause, Miss Maputa. You can talk to Miss Jansen van Vuren and do it the way you normally do it. At 1900, we are back. Everyone, please, thank you. And also to those that are following us, please, we will be back at 1900. Thank you very much. It is 1900. I think we are all back. Mr. Majola, your hand is up. I'm back. Let me just check the other members. I do know Mr. Mkize has some timing, but I see he's still here. Thank you, Ms. Masetti. Mr. Mkize, you here? Or you? Maybe he just left a system to locked on. He's got an emergency that he needs to attend to. He will be back. On that note, members, I take it that we are ready. We need to then proceed with the other applications that were stood down. Ms. Maputo, if you can remove the pause and we inform the public that we are back.
You may continue, Chairperson.
Okay, thank you, members. Thank you, management and staff and NESA staff members. We are now going to continue with the matters that were stood down in the morning. And to our members of the public, we've got 3 items that we are going to be dealing with before we close our session. Emadlangeni Municipality, Ntate Kgare, over to you. It is on page 20, members of the first page, page 20. Thank you. Over to you, sir.
Thank you, Chair. This application of Emadlangeni is coming for the second time today before the members. Members asked us that we should deliberate on certain issues such as the costs that are associated with the revenue requirement. Chair, I just want to start with those major things that the members has asked us to do. So they will going to enhance the table to reflect the expenditures individually for transparency. So we're going to include these costs such as the bulk purchase in our table, material and suppliers, salaries and allowance, contracted services, depreciation, bad debts, and other general expenditure. I also like to touch on the major issues that are risk associated with the surplus, because on our analysis, even after keeping the losses at a lower level, the municipality is still showing a negative, a deficit. So, Chairperson, the night safe is the biggest factor, and fortunately, after the approval of RTP, this one is going to be solved, because municipality, they are going to or they are currently implementing or the new tariff from Eskom that has got no night safe, which used to be the most expensive tariff. And also another big factor is the interest on Eskom debt, the NMD, and the low collection rate. So the municipality has been encouraged to honor payment arrangement with Eskom and making sure that they settle the debt and improve on the low collection rate, and also recover the revenue that they've lost as a result of high energy losses. Chairperson, this application of Emadlangeni Municipality has been consulted by both NERSA and the public and the municipality, my apology. So there's been a serious objections of stakeholders opposing the application on the municipal side, because initially this municipality wanted to apply to NERSA the 13.2%. That's what they went to public with, and after the serious objections, they later revised the application to 10%, taking the comments of the public. And from our side, we received one comment, which actually was based on the affordability of the 13%, and the comment is indicated in table 6 and our analysis as NERSA. So, Chairperson, the application is based on the cost of supply, which was being revised because of changes in Eskom tariff. The cost plus methodology was used in assessing and analyzing the cost of supply. Share cost together with the OPEX and CAPEX were verified on the audited AFS. So, Chairperson, if I may take you to the recommendation, they read as follows, but also other important comments and guidance that were given by the members gonna be take them into account when rewriting the RFD and put it in a proper manner that the members have guided us to do so. So I would like to read or before that, the application is at 10%, and our recommendation is also at the same percentage. And the recommendation read as follows: we are kindly asking the members of the REC to approve these tariffs to be implemented from the 1st of July, and also to note the cost of supply based tariffs, and also that the municipality must submit to NERSA the quarterly progress on the losses, because they are losing more money as a result of these losses. So we'll want to track it and encourage them to really do what is right. Thank you.
Thank you, Ntate Khari. You know, what would have been easy was for you to focus on the points that members had raised than to repeat the presentation. And for me, I just want to double check with you, and the members may come in just to be quick so that we can do the same for the next two applications. It was whether what is or are other risks to the municipality other than the energy loss. That was the first question. And there was a need to clarify paragraph 4.4.1 on page 33 on the amount mentioned there. And there was a request on the standardization of table 4. We've noted that you'll enhance it. And there was a request for you to, on the revenue analysis, to indicate the depreciation. I think it was the number I have there. It's 2.78, I think it's 2.78 million. And the 21.8 million that the municipality is requesting on 4.41 as well, it was said that it be clarified. And the 637, I think it's there was an issue whether that's 637,234, whether it was millions or thousands, and the assumption was that it should be thousands. You should be correcting us on that. So those were the points that I've highlighted. If you can cover them so that I can check with members if they believe all that was raised during the discussion of this application has been covered. Over to you, if you can just cover those points. Apologies if you did, but I didn't pick them up in that particular manner. Maybe it's based on what I was the manner in which I was expecting you to respond. You may come in and Harry.
My apologies. The figure mentioned is not in millions, so I didn't mention that.
Where are we now? Where are we now? Just guide us so that we don't miss what you're saying.
The surplus figure on the revenue requirement.
Okay. It is what?
The 600 is not in million, is 637,234.
Okay.
Resulting to 3% requested surplus. It's not in million. It's an error that we made on our side. We apologize about that.
Okay. That was the first verification that you had to do. The next one.
The risk associated with the surplus after we have kept our losses to a lower level is the night save, tariff, interest, the NMD, and the low collection rate. And the paragraph 4.4.1 on the revenue requirement, it's in line with the with the revenue requirement that the municipality is applying for.
Okay, there was also an issue of depreciation.
Okay, thank you, Chair. My apology also on that, but I highlighted earlier on that the cost table we are going to enhance it to include other expenditures for transparency as advised by the members, and other expenditures we're referring to the bulk purchase, material and suppliers, salaries, contractor services, depreciation, bad debts, and also shows that it's been limited to 5% as guided by the members. Thank you.
Okay. Thank you for that verbal elaboration on the depreciation components. Ms. Masete, I see your hand is up. I think on my notes you have covered all that was needed. Ma'am, you may come in.
Thank you, Chairperson. Chairperson, I think the way that it should be covered, because yes, the mention on the revenue table is one thing, but what he needed to do is go back to and come back and tell us that I have checked the audited financial statement and I checked the balance sheet. I found that there is X amount of the asset values. And I verified that X amount, yes, there is one that can be attributable to electricity business, and it is X amount for the electricity business. And this is corroborated with the asset values, of which asset values, the assets themselves or infrastructure related to electricity. And we verified that infrastructure, that it is X, this equipment, and that equipment. And they make up this value. From that value, we then calculated depreciation based on this and verified it, and then it does give X amount, because the depreciation that is there, he is not even telling us, because that depreciation is an aggregated depreciation, which might actually entail a depreciation for all of the other municipal services. So that aspect is not coming out, and it has been said many times, even by others, when I pointed it out, to say, you can't just take a figure that you get from the audited financials. And then they confirmed others that were not lazy to go back and check these things. And then they came and said, yes, Ms. Maseti, you are correct. It's aggregated in certain instances. In other instances, we at least get it split out. So we're not still getting that aspect. And for us, it's important. And even that surplus aspect that I asked, quite key. And I would like for the team here, as I step off this item now, or this application, to give due regard to policy position 54. And that policy position 54 is quite important on issues that are not transparent, and making it very clear that under no circumstances shall they, I think the other one is about the municipal surcharges and all of those things, be introduced in addition to the current non-transparent, it's all of those things that they can, non-transparent, unring-fenced surpluses. That's our policy position, EPP. So when we ask things about the surplus, we're not asking these things and to say the surplus is too much, because it is clearly stated there, if you could go on, because that sometimes that surplus, when it's so much and it's in the cash reserves, for what? It tends to finance or fund the other businesses of the municipality that are not electricity related. So if we can also just give due regard to policy position 54. Thank you.
Thank you, Ms. Maseti, for that guidance. Tabo, your hand was up. I just want to guide on this one in terms of what we need to do. Do you still want to come in? Mr. Shabalala?
No, Chairperson, I'm covered.
Right.
Thank you.
Okay. Dr. Khari, can I just try and guide that? Can you go and address these issues and bring this submission tomorrow and cover that point? I don't know if you have an answer to assist the committee with that issue raised by Ms. Masetti, particularly on, I think I picked up the one on the depreciation. She just gave more details in terms of what is expected.
Thank you. Noted, we'll do so.
Okay, thank you. Let's just bring it back so that we don't waste time. And then we'll move on to the next one on George Municipality. Ms. Mapinya, the main thing that made us take this application out and say bring it later was the main issues was what was on the surplus. What was the Munich going to do with that surplus? And you were to contact and find out what is the response. And also there was a point to say that if it is reduced, meaning the surplus, we need to ensure that there is cost reflectivity and efficiencies. And the other one, that's the reduction of the surplus. I've touched on it. Focus on these 2 points, and then you may wrap up by just confirming what has been applied for by the Munichs and what are we recommending, and we go to the recommendations. And I'll allow members to really come in and see if everything that they had asked that you address is being addressed. Over to you, Ms. Mapinyo.
Thank you, Chairperson. As in terms of the surplus is representing a 10% of the total electricity revenue, and it falls within the approved framework range of 10 to 20%. The municipality chairperson is responsible for maintaining, upgrading, and expanding the electricity infrastructure. And this really requires ongoing investment to ensure a reliable and a sustainable electricity supply. The surplus will be utilized as a contribution to the capital replacement reserve for the replacement and upgrading of aging electricity infrastructure and equipment, and the repaying of existing and future loans used to fund the electricity capital projects, since they have already implemented and have also planned major electricity projects and renewable energy projects to accommodate the changing electricity industry. And it will also be used for future electricity network expansions and energy security projects, Chairperson. The funds will be ring-fenced specifically for electricity related projects, and will further be verified in the intervening periods between tariff applications to ensure that these funds are used solely for the intended purpose, Chairperson. And then, Chairperson, you asked that I confirm they are applying for a 7.88 increase for their tariffs. The cost of supply study gave results of 18.5. And Chairperson, the recommendations are on page 44, and therefore the committee is requested to approve the tariffs that are based on the COS report for implementation by 1 July 2026, and to note the cost of supply report submitted by the municipality, and that the municipality is required to submit a report accounting for all these costs that have been noted in the cost of supply study, so that NERSA is able to audit and verify these costs. Thank you, Chairperson.
Thank you, Ms. Mapinya. Members, questions, issues of clarity? Yes, Ms. Masetti, you may come in, ma'am.
Chairperson, I don't know if I must say it's now issue of clarity, but it's an issue now that I must just again emphasize. It is guidance. I've just said it before Ms. Mapinya presented. Remember when we sent it back on the basis that it is not justified, like we do not have a sense of what the municipality is going to do with that much surplus in its hands. That's the first thing. So we at least needed to understand what is it that you're going to do for us. And we know the basics, even in the other areas, that you don't want to, overcompensate on surplus. That is the first thing. We know it's a general principle that we know that one. So let alone the fact that we're talking about this thing of 12% or 10% to 20%. Please let us keep that aside. Why? From the word go, we guided that. Please, as you have that framework, it does not exist on its own. And it will not, prevail or trump the Section 15 read with the electricity pricing policy. It will not. It must fit into the requirements of those empowering provisions. The policy read with Section 15. And then we said, in as much as MFMA talks to it, let us try to harmonize in the way that we read, so that where we need to bring it down, whether it's 2%, 9%, or whatever, we are still allowed. Don't take the fact that there's a 10% thing if it's not supposed to be 10% based on the circumstances, on the merits of each case before us. That's quite key for us. And then I am now also saying that when I just made reference, and maybe they can cite Mr. Murati here to assist, and Mr. Chok to assist in this thing of his surplus, that even when we provide the surplus as a buffer, and in other instances, it may well be used for refurbishment of some sort, the policy cautions against the use of that surplus for other reasons. And it calls for ring fencing. And I am referring to policy position 54 in particular. I don't know how else Chairperson can guide. I have put it also on the chart just to clarify why it is relevant. Thank you, Chair.
Thank you, Ms. Massetti. My mouse is misbehaving again now. Apologies for the delay. Mr. Majola, you may come in, then I'll see if the Murati or the Choko would come in.
Yeah.
Over to you, sir.
Yeah, Chair, what I was also going to propose, I know maybe I'm sounding like a broken record. I would again say, let us delay the decision on this one. I think through the night, the team will have to think and take into consideration all the comments that have been made, and then come up with a revised presentation. I think we must realize, obviously, that we are actually running a marathon here. If you look at the number of submissions per day, if you look at the number of meetings we've had already, and also if you bear in mind that on Monday we've got a deadline, court imposed deadline, whereby we've got to meet the deadlines imposed by the courts. So what would probably tend to happen then, Chair, is that everybody is working under pressure. And I also think that therefore it probably gonna help if for certain of the submissions we take time out, like a team, halftime, the team and sit down with the coach and they strategize for the next half of the match. So I'm saying for some of these submissions, it's inevitable that you're probably going to have to go back and think a little bit more and come back to the next committee meeting. So I suggest that we actually then park this one for tomorrow. But having said that, I do agree, because I know that, Chair, you also called upon Mr. Murati and Mr. Choge to come in as well. They can come in, also give us some more advice, give us more things to chew upon overnight. Thank you, Chair.
Thank you, Mr. Majola. Ntate Murati or Chokwe, I don't know. You can raise your hand if you want to start first. Do you want to come in, Chokwe or Murati?
May I look into this from my side, unless Mr. Chokwe or Ms. Mkize would want to talk to it, that we look into it so that we provide a written guidance to the committee and the colleagues from our legal understanding of the situation.
Okay, thank you. Can this be provided to them prior to coming to the meeting tomorrow?
Yes, Chair.
We can take that input into account. On that note, Ms. Mabinya, yes, that's what will happen with your application. And I think for me, as you take it back, clarify to me, maybe I'm just not understanding. I thought that issues of maintenance, it's covered in terms of our deforms. We normally give them that allowance, and that will be taken into account in the analysis. And I heard you saying that the surplus is also used for maintenance. And I would have thought that the expansion of infrastructure is what could be covered by it. But tomorrow when you come in, please do address this point for me so that I get my head cleared. Maybe I'm mixing up my understanding of these amounts as to where they are put up. We'll then go on to the next one. Ms. Masetti, I take it you support that we refer this one back. I didn't put this on a vote. Mr. Majola supported. Yes. Thank you. And the last one that we had that was stood down is the Inkosi Langalibalele, and that the Tawalala, over to you.
Apologies for that, CEO. I was struggling to unmute. Good evening, members and colleagues, once again. In terms of the issues that I've captured, CEO, and I hope I've captured them as members had intended, the issue was around paragraph 4.7.3 on Inkosi Langalibalele, and we saw it's something that came up also in Newcastle and the subsequent one, because we are referring to the same template. So on paragraph 4.7.3, Chairperson, it made reference to 1.1 billion instead of the correct amount that is supposed to be 415 in line with the table. And then on that one, Chairperson, once again, it was making reference to table 3 below as opposed to table 4 below. That will be fixed, Chairperson. The other issue that was identified was around table 1, which made reference to approved tariffs of 12% instead of 15%. Chairperson, the table was not updated from the tariff analysis section. And then lastly, Chairperson, there was guidance which was overall encompassing to say that the issue around referring to OPEX as accounting for 9% under table 5 should be corrected, and that will be done, Chairperson, to ensure that it reads correctly to align with the labeling on the table, Chairperson. And then lastly, I had already spoken to it when I presented to say that the table of OPEX will be further broken down, and I already did speak in terms of the elements that are going to be included in there, and I even quantified the amount for depreciation at 9.4 million and confirmed that it was verified in line with the asset in the audited financial statements, Chairperson. With that being said, Chairperson, the cost of supply study indicated that this licensee requires a 21.9% increase to be cost reflective. However, this licensee is applying for 15%, Chairperson. With that being said, I would like to read out the recommendations, Chairperson, which are requiring that the RSC approve the tariffs that are based on the COS report are approved and are recommended. The tariffs that are based on the cost of supply report are approved as recommended in the tariff analysis section for implementation by the licensee with effect from 1 July 2026. The cost of supply report submitted by the licensee be noted, and the licensee is required to submit a report accounting for all the costs that have been noted in the cost of supply study to enable the regulator to perform its independent verification or audit process by 30 September 2026. The municipality is required to submit quarterly smart energy losses reduction progress reports for the regulator to monitor implementation thereof. Thank you, Chairperson. I hope I've covered all the points, Chairperson. Thank you.
Thank you. I'll put that to the members. But one that I think you didn't answer, just note it down, was table 3. I think there was an indication that the losses have doubled. If you look at them, they've reduced. However, was it? No, let me just stop. I think I may have written my notes in an incorrect manner, but there was an issue in terms of the losses having been doubled, and we're saying in the submission there were no inefficiencies. So that was the question that was raised. I think maybe this was linked to the high deficit of 20.45. But I think Ms. Maseti asked this question. I'll ask her to clarify it for you if I have noted it down incorrectly. Ms. Maseti, you may come in and assist.
You've covered me, Chairperson, because it needed to be reflected, and also then the risk sharing principle there must apply in the form of downward adjustment. And then the second thing, it was the depreciation, just for the verification, and indicating that there is that verification specifically on the figure itself of depreciation. So that's the part that has not been covered. Otherwise, others have been covered. I'm fine with those, Chair. Thank you.
Okay. Thank you. Dr. Chabalala, you want to come
Thank
in?
you. Yes, thank you, Chairperson. In terms of Nkosi Langali Balele, Chairperson, I suspect you might be looking at, maybe you might be confusing it with another licensee, because on this one, while yes, the losses have increased, but this one is sitting on a surplus. So on this one, Chairperson, when we track the trend of the losses over a period of 5 to 6 years, Chairperson, you find that they are generally hovering around your 8%, 9%, 10, 11%, but they never exceed sort of the 11% sort of. So all we are saying is that we are not expecting that the losses would remain sort of constant throughout the periods, Chairperson. They have a fluctuation range, and on this one, we are comfortable to say that they are well under control, Chairperson, and generally below the 11%, although they might appear as if they've grown from one year to another, but generally these losses are not a cause for concern for this municipality, as they are under control, Chairperson. On the issue of the depreciation, Chairperson, we did verify this figure, Chairperson. The depreciation is amounting to 9.4 million, Chairperson, and this has been verified in line with the audited financial statements, Chairperson. We can verify that. Thank you.
Oh, Mr. Chabalala, yes, thanks for correcting me. I was on the wrong losses. Yes, I was on the previous greater letter submission. We are saying the increase from 6.15 to 11.54 shouldn't be making us concerned about that. I think it was said it's doubled. I don't understand, because we've been looking at municipalities that have got high energy losses, and we've highlighted that this really needs to be addressed in terms of the revenue calculation. But if you're saying it's not something we should be concerned about, I'm just worried. I don't know. Let me just allow the other members to see if they've got any comments or follow up on this, on your presentation. Ms. Maseti, I think the depreciation was mentioned as 9.4 million, but I think the question was verification. Mr. Chabalala explained. I don't know if you're covered on that. Is there any other point that was raised? Okay, you are covered. Thank you. But Dr. Chabalala, I'm not a mathematician, but that energy loss, are you right with what we have said about the losses that have doubled? that we shouldn't be concerned about them? Members?
Yes, Chairperson. Apologies, I struggled to unmute, Chairperson. Generally, like I said, there are times whereby there will be that spike, but generally for this particular municipality, not for all of them, there are certain municipalities whereby if they were to experience 50% increase, such as this one or higher, they would be cause for concern, not this particular one, Chairperson. Thank you.
Okay, all right. Let me allow Ms. Masetti, then we'll just see how we proceed on this one. Ms. Masetti?
Thank you, Chairperson. I think the wording there is improper. We can't say that when the situation, the performance is deteriorating, and then we say it's not a cause for concern. What we can say is that it is something that needs to be controlled and looked at carefully. So that's all that we can say, but it is not at the level at which perhaps we need to, if it's at 11%, that we need to kind of punish and say we start implementing the risk to punish the municipality, the risk sharing to punish the municipality or to make the municipality account. But we can then say that it's something that must be looked at. So for adjustment purposes, maybe this is not the time to adjust it downward because of that, but something that we must look at. So it's not proper to say it's not alarming, and secondly, to use the term that says it is stable. It is not stable, the fact that it is deteriorating. That can be. And then on the depreciation, I am fine, Chairperson. I think we can take it on there. Thanks.
Okay, thank you. And Dr. Chabalala, I think you have noted then the assistance in terms of enhancing that point on the energy losses. And I think members, we can then take we can vote on the applications, the recommendation are on page 130 to 131, and they have been read into the record with those enhancements that have been provided by Mr. Chabalala, and as well as others that have been made by members in previous application. By show of hand, can I get an indication that you support that? Thank you, Ms. Masetti. Thank you, Mr. Majola. And I do. And that was the last application that had to be returned today. We do have the others that we still are going to be expecting to come tomorrow together with the other batch for tomorrow. On that note, we have come to the end of our open session of the meeting, and may I thank the members and the EPT team and the managers that are present, and as well as the members of the public that have been following us. We have come to the end of our open session, and may I request IT to assist in stopping the streaming so that we can